Much volatility was seen in the Japanese yen last week on talk of a so-called currency war, and on concern that the expansive policies that drove down the currency would be criticized by the G7 and G20 leaders. The G7 statement released in the early part of the week and subsequent comments from officials confused the markets. But in the end there was some steep sell-off in the yen late Friday on news that the depreciation of the Japanese currency won't be singled out. Indeed, Japan escaped from criticism by the G20 statement, which ended with a pledge to refrain from competitive currency devaluation. The yen's downtrend is now set to resume this week as this uncertainty is cleared. Meanwhile, the euro extended its correction last week as data showed a deepening recession in the eurozone and as traders lightened up positions ahead of elections in Italy. The sterling also weakened broadly after a dovish Bank of England quarterly inflation report. The New Zealand dollar was surprisingly the strongest currency last week after some positive economic data. From a technical point of view, the euro's correction against the dollar seems incomplete, and it also faced some difficulty in resuming a recent rally against the sterling and Aussie. However, as the euro's correction has lasted for 2 weeks already, there shouldn't be much room for a further downside. And based on these two contradicting facts, we'd avoid euro this week. The uncertain near-term outlook in the euro also makes us prefer to avoid the sterling and Swissy. Meanwhile, commodity currencies were mixed. While the New Zealand dollar was strong, Friday's sharp sell-off showed signs of near-term topping. The Australian dollar is still bearish, but there wasn't any convincing sign of steep fall ahead. Nonetheless, the Canadian dollar looks set to accelerate its decline against the US dollar. And as mentioned above, we do believe there's a high chance for yen to resume its downtrend this week as the G20 uncertainty was cleared. After a 2-day meeting in Moscow, the G20 leaders agreed to a joint statement with promise that they would refrain from competitive devaluation, and resist all forms of protectionism to keep our markets open. Meanwhile, they also pledged that advanced economies will develop credible medium-term fiscal strategies. The Japanese yen was not singled out in the statement, and suggesting Japan is given a green light to continue its expansive policies. The statement was not much different to the G7 statement released earlier in the week, stating that G7 policies will remain oriented towards meeting our respective domestic objectives using domestic instruments, and that we will not target exchange rates. Japan was the major focus last week. In addition to G7 and G20 talks, Japan also released its Q4 GDP figures. Japan's GDP unexpectedly contracted 0.1% quarter-on-quarter in Q4, versus consensus expectation of a 0.1% quarter-on-quarter growth. That's the third straight quarter of contraction, even though it improved from Q3's 1% quarter-on-quarter drop. Japan is still in a mild recession, and the 0.6% quarter-on-quarter fall in deflator indicates that Japan is still staying in deflation. The data should strengthen the case for Prime Minister Abe to push for more monetary stimulus to end deflation and boost recovery. The Bank of Japan left rates unchanged at 0 to 0.1% on an unanimous vote as widely expected. The stimulus programs were also left unchanged. The central bank noted that Japan's economy appears to have stopped weakening, and the pace of export decline has slowed as international investors' risk aversion has abated, and the global economy has shown signs of picking up. The Japanese economy is expected to level off more or less for the time being. CPI is expected to turn negative due to a reversal of energy prices, but would then be back around 0% again. The Bank of Japan pledged to pursue an aggressive monetary easing, but emphasized that it aims to achieve price stability on a sustainable basis, that is achieving its 2% inflation target at the earliest possible time. Talking about the Bank of Japan, it's reported that Prime Minister Abe is close to making a decision on the next central bank head, who will replace Shirakawa on March 19. Former Bank of Japan Deputy Governor Toshiro Muto is being reported as the front-runner, and he's considered by the markets as the least dovish candidate. In the Eurozone, Q4 GDP contracted by 0.6% quarter-on-quarter versus expectation of a 0.4% drop. That's also the third consecutive quarter of contraction, and the situation was even worse considering that the best of the last 5 quarters of 0% growth was back in Q1 of 2012. And Q4 was also the worst quarter since Q1 of 2009. More worrying was that Germany, France, and Italy all recorded disappointing results. Germany's economy contracted 0.6% quarter-on-quarter compared to expectation of a 0.5% drop. France contracted 0.3% quarter-on-quarter versus expectation of a 0.2% contraction. Italy contracted for the 6th quarter by 0.9% quarter-on-quarter compared to expectation of a 0.5% contraction. In the UK, the Bank of England's quarterly inflation report showed that policymakers are ready to tolerate higher inflation to boost economic recovery. While the Bank of England expects the UK to have slow but sustained recovery this year, the growth projection for the year to the first quarter of 2014 was revised to 1.7%, down from the prior projection of 2%. The economy is expected to be back to the pre-crisis level by 2015. Meanwhile, inflation is expected to stay above the central bank's target of 2% until at least the end of 2015, and will peak at 2.3% in the second half of 2013. However, the Monetary Policy Committee emphasized that, as long as domestic cost and price pressures remained consistent with inflation returning to the target in the medium term, it was appropriate to look through the temporary, albeit protracted, period of above-target inflation, and attempting to bring inflation back to the target sooner by